Thank you everybody for joining us again. Our webinar today is on alternative financing and deal making, how investors are overcoming fundraising hurdles during this unprecedented pandemic, as it were. So I'm Michelle Teo, part of the team here at Deal Street Asia. So the panelists that we have today with us are Harold Ong, who is Managing Director at Xen Capital Partners. He's based in Singapore. We have Katrina, the co-founder and group CEO of Xen, who's in Hong Kong. And Kyle, who's also in Hong Kong, the founder and managing partner of ShawKwei Partners. Our panelists will be able to give more detail about their business and current areas of focus as we go along. So today we're going to be talking about how, everybody understands how the pandemic, as it were, has kind of wreaked havoc on business and markets and the broader economy. So there's already been quite a lot of coverage on industry sectors, who the winners and losers might be as a result of the disruptions, and in which areas that investors can find opportunities. Today in particular, we're going to be discussing the growth of alternative financing and where or how one can find the best value, as well as some of the challenges and risks of those strategies. So let's begin. Now, alternative financing, is rather a broad description of the various strategies, I suppose, that private capital can take, including like special situations, mezzanine, and so on. And the assumption is that in such a market or crisis, there'll be plenty of opportunities. But however, there's also been significant central bank and government support for, for businesses, for the economy. So maybe Harold, let's begin with you. Xen Capital has just hit its first close of 100 million for its third special opportunities fund. Maybe you could just tell us what are these special opportunities, as it were? Yeah.
Sure. So first of all, we're obviously very pleased that our investors are backing us during this unprecedented period. We do see ourselves as an alternative capital provider. We span the spectrum from private credit, mezzanine, to structured equity type transactions, as well as private equity style transactions as well, although that's a little bit more of a niche for us. So in this type of environment, there's a lot of market dislocation, obviously. Perhaps we haven't seen bottom yet from a real economy perspective. I think part of that is that obviously takes time. And the stimulus that has been provided by governments and subsidies, etc., has obviously helped the economy to keep on going. Some sectors, as we know, have been hit much harder than others. As you can imagine, hospitality has been hit fairly hard, but then things which are tech-based have generally tended to do better, particularly the ones that rely more on an online presence and more delivery type of mechanisms. So the e-commerce, the logistics type of businesses have done fairly well in this environment. So with that said, it's actually quite broad in terms of the opportunities that we look at. We look at traditional deals. We also look at tech businesses. Tech is getting far more entrenched in economies all over the world, and I think Southeast Asia is no different. We're maybe earlier stage, but there's certainly a lot more tech and tech-enabled businesses that we are starting to look at. So believe it or not, in this period, we're actually seeing opportunity sets that come about for various reasons. For one reason, it may be that they just need more capital because actually they're growing a lot faster. That would be probably the minority of transactions, but we're certainly seeing it, for example, in the logistics sector and anything which is more e-commerce related, as I mentioned. And there is, of course, the more traditional businesses and businesses now that are, not doing as well, right? To be honest, I think we're being patient. I think the opportunities will come, but perhaps the real economy hit also hasn't happened in full.
Mhm.
So, we see ourselves as pretty flexible across the capital structure. Indies has done, traditional mezzanine type deals, as well as more structured type transactions. So we're seeing a lot of opportunity. I think we've been very busy during this downturn, but I think we're being patient as to what sort of deals we want to look at.
Right, right. I mean, I was going to ask, it's a special opportunities fund, but is it really opportunistic though, or more strategic actually?
Yeah, it's. I think it's actually a bit of both. So, strategically, who are we trying to back with our special opportunities fund? It's actually very established business groups and conglomerates. They would be the kind of the top businesses and families. We continue to like backing very blue chip type companies with strong underlying cash flow, but perhaps because of the market dislocation in this pandemic, certain business lines have been adversely affected, or funding lines are not that available from your traditional bank channels, right?
Mhm.
So then we can kind of replace that. We don't see ourselves as true kind of distressed folks. So things where things are teetering on the brink, and you have to go in and send full teams in to do kind of an internal restructuring. I don't think that's our general modus operandi. We tend to want to support very good business groups, whether that's expansion capital, whether that's acquisitions, or refinancing scenarios, debt buyback, or in certain cases, yes, rescue financing as well. But again, we don't want the whole enterprise to be in distress. So we're not real distressed players. We see ourselves as special opportunities in the truest sense of the word. We're pretty flexible with what that means. But we generally still want to back good companies, good conglomerates, good families. So it's still supporting these things in times of need because of market dislocation.
Right, right. Katrina, maybe we'll go to you. Can you provide some insight into what sort of assets or asset classes that investors on your platform are allocating or perhaps reallocating to at this time?
Yeah. So just to provide a little bit of context, Xen Capital is a full-fledged alternative investment platform. So we connect accredited investors with opportunities across the whole alternative space. So we do have a wide range, private equity, venture capital, hedge funds, private credit, real estate, as well as direct investment opportunities. I would say compared to sort of the pre-COVID timeframe, we have seen a pretty big shift amongst our client base, which are primarily accredited investors and family offices, from kind of like longer term closed-end fund opportunities to shorter dated opportunities, more open-ended structures, and also away from kind of the more kind of maybe earlier stage, riskier kind of venture capital opportunities towards more private credit, income-oriented type of products. That's kind of on a very general level.
Mm-hmm. So apart from the market dislocation that Harold was talking about, what are the other factors that's driving investor interest on your end?
Yeah, there are a few different trends that we're seeing. I mean, we're really more of a, I would say there's with a lot of our clients, we're really more of a kind of a private wealth proposition as well. So in addition to the market dislocation, which is, creating like a need for investors to diversify and to explore other opportunities, we're seeing a lot of sort of tailwinds or trends around geographic diversification, especially for Greater China based investors. I mean, I think this has been a fairly common theme for the last 12 months, but probably more accelerated today. It's just like a need to sort of book assets out of Singapore and things like that, for example. The other trend I would say we're seeing in general is I think with a lot of Asian countries, there's a generational shift of wealth. So people are now looking to kind of have a more organized structure for, especially around kind of family offices or multifamily offices, and trying to invest in things in a more systematic basis.
Okay. Kyle, perhaps you could talk about the various approaches that one can take for an asset or one company, from whether is it getting into distressed debt first and later equity, or perhaps a roll-up strategy on your end?
Okay. Well, let me talk in the context of today's world and what we're facing. And this is an obvious statement, but this pandemic is truly global, and it's unlike anything we've seen. What makes it really peculiar is the fact that it is so global. We've had crises, whether it was the global financial crisis, SARS, the Asia financial crisis. Those were more concentrated within a region of the world. And yet today, the pandemic is global. But when I talk to people all around the world for business purposes, I find that they all have a different interpretation of what's happening, what the pandemic means to them, and how it's affecting them. And I found that very curious. There's not really a common theme that you can follow. And I think the same is very much true for companies. I think companies have a very different reaction. So depending on the industry and depending on the company that you're dealing with, you probably have to adjust your strategy and the way that you interact with them. So probably in the early days of this pandemic, we would have thought that illiquidity would be a opportunity, right? Helping companies that had a liquidity crunch. But yet, I mean, the central banks globally have been so free and liberal with lending that actually lending terms are more relaxed and easier than they were pre-pandemic. Mm. So you take away, I mean, there are truly distressed companies, but they're generally so far gone that there's just no hope. Mm. Same can be, maybe we can venture into growth capital. In today's world, if you're growing your business, and there are companies that actually a small minority or percentage of the universe, but they're doing very well in this environment. Mm-hmm. And if they need capital, banks again are freely lending to them. The IPO markets are hot as a pistol. Equity markets are very strong, and so probably if you wanted growth capital, there are cheaper alternatives than private equity that are readily available. So that leaves a couple of other themes. Succession planning. Companies that, where the old owners have reached a point in their life where they want to retire, or maybe they don't have a natural succession. Actually, that part is probably accelerated, because I think the challenges of the pandemic are encouraging people to say, maybe there's something more important in life than, going into the office 6.5 days a week and doing what I'm doing. So I think opportunities for owners who have decided that, this is a new game, there needs to be some fresh blood, some new thinking. That I think is quite a good opportunity. And then you kind of alluded to it. I think consolidation plays. Those are very attractive to us, because if you're already in a particular portfolio company, you know the industry well, then looking to acquire, merge with a supplier or a customer is relatively straightforward. Due diligence can be expedited because of your knowledge of the industry and the players. And it can be compelling. It can be a win-win for both companies to do something like that. Mm. So I think those are, as of today, those are the opportunities. I would say stay tuned, because this pandemic has been very erratic, and perhaps we're going to have a, more of a W-shaped recovery where we go up and down, up and down. And certainly at some point, the liquidity spigot will be turned off. But I think in the last several months, those have been the primary things that we're looking at. Mm.
But is it just about the money though? Given that the market is flush with capital, what else is it that businesses or business owners or these, borrowers, if you will, are they looking for? Why would they come to you versus, say, the banks? Harold?
Yeah, no, first of all, I don't think that liquidity exists in every single pocket. Obviously, equity markets are at a high, but I think there's a real dichotomy in terms of what's doing well and what's not. I think the new economy sector has obviously done a lot better. And it's now a very, very big part, for example, of the US stock market. So when people see it do very well, actually, it's only a proportion of the businesses. We do concentrate a lot more in Indonesia, so that I'll talk about that market perhaps in particular, but the liquidity situation, I think, is still not great. I think, banks are being very, very careful with where to put out capital. Obviously, they've been told to try and support businesses, to give holidays on repayments. And so they're not really in the mood, I think, to take on a lot of new credit either, right? So one of the things we've been doing, and we've been quite lucky in the sense that we have our team split between Jakarta and Singapore. So even during this crisis, we have been able to have people meet on the ground in Indonesia. We can work offline and online as well, and we try and be helpful to all stakeholders because of our significant presence, I think, on the ground. So, you know, we can see deals live as they happen. And we can be flexible between tech businesses, which I've said is becoming more entrenched in the economy as a whole, as well as more traditional type businesses. So that having that on the ground presence, I think, gives us a look into a lot of these situations. And there are companies facing a lot of liquidity issues. So the capital markets, I think for Indonesia in particular, for example, is not quite as open as they are in the US, and what Kyle mentioned earlier, that, you know, the IPO markets are red hot. I think you need to look at specific markets. Right. And the capital markets in Indonesia in particular, I still think it's down. And certainly I think new deals such as bond deals on the DCM side will continue to struggle. So that's where we kind of come in. We try and be helpful to stakeholders. As I said, our main business proposition is actually to back a lot of the big business groups. And there will be pockets of illiquidity because of what's happened. And not every business is the same. Some are obviously going to be more impacted.
But I mean, just wondering, apart from liquidity though, I mean, are there other aspects that they come to you for?
Yeah, they do. You know, we're looking at a transaction now where, as I said, it's the opposite. It's a business that is doing better in this crisis because it has to do with online delivery. And so, you know, there's an opportunity there for more capital to go in the business, and it's actually to build infrastructure and grow. So we're looking to support that business. You know, fundraisings are probably going to take longer in this environment, right? So in a sense, part of our business is also being an equity replacement. As I said, we also do private equity, a little bit more niche in nature. We don't compete with the traditional PE funds, but we do take equity exposure. And we will replace equity as a tool where it's more structured, perhaps, right, in nature. And so there's a little bit of a debt component, a credit component, as well as kind of an equity outcome. And it works well in this kind of environment because I think, you know, we can probably move a little bit quicker or a little bit more nimble, right? And we can structure things, which is perhaps, you know, there are two outcomes. It can end up as a credit instrument, or it can end up, if things go well, as an equity instrument with an equity kicker.
Right. But in this case, then, what is the typical cost, though, for cost differential between alternative financing or the kind of approach that you take versus, say, bank borrowings? And actually, this is a question from one of the audience participants. Yeah.
Right. So, you know, I think for good credit, banks will still be there. They will still be there to support key clients, key groups. But if you look at some of those, for example, that need to refinance high yield bonds that are coming due, now is certainly not the time to go and tap the high yield bond market. So to replace that with debt borrowing will probably be difficult because that, you know, the business is probably leveraged. Now it may even be more leveraged, at least from an earnings EBITDA to debt type perspective. And so you need to look at alternatives. Are you able to do a kind of debt buyback scheme? Are you able to put in different funding lines to kind of take you through the next couple of years, right? So I think, of course, you're not going to end up paying, you know, bank debt. It's not a LIBOR plus a few percentage points type of business model. I think in a structured type transactions, you would look for, you know, kind of a double-digit yield, maybe circa 10%, and then you share in the upside. So if things go well, you try and have the kicker really provide some of that upside to the investor. And so you get kind of a more mezzanine or even low 20% type of returns.
Okay. But Kyle, I mean, just wondering if you could give us some insight into one of ShawKwei's most recent transaction, I think in May, with
Mm.
ICS in Hong Kong. I mean, I understand that the plan was to build out ICS with strategic acquisitions. I mean, how does it work? Where does ShawKwei come in?
Okay, well, that's a good example. I mean, in this case, we are helping them to find, source, and structure deals. And we're looking at the industry in which they operate. So it's suppliers and competitors. And ICS is a cosmetic packaging business. It's truly a global business. Most of the manufacturing does happen here in Asia, but the target customers are located Europe, Asia, and North America. And so it's a global industry. The brands are global, and I think our ability to help bring ideas, to bring structuring advice, as well as capital. At the end of the day, we're the ones who are going to be writing the checks and helping them to fund these acquisitions.
Mm.
So this is a case where we got to know the owner and the management team at ICS very well. We understand what they want, their strengths, their weaknesses, and once we get into their ecosystem, it's quite a joint effort by us and the management team in looking at deals and letting them bring their market knowledge and management experience together with our financial acumen together.
Okay. What about the much earlier deal with Gaylin Holdings then? Could you elaborate a bit about the timing of that deal and what were your expectations then and what's changed since then? I mean, I think you said at the time that you expected the deal to generate positive returns in 5 years. I mean, what do you mean by positive at that time and what about now?
Okay, well, I mean, in this case, Gaylin bought Amos, and Gaylin was a listed company at the time, and we since have rebranded the merged company as Amos Group. And so anytime you're talking about returns in a public context of a publicly listed company, you have to be rather circumspect in how you describe it, because you don't want to be promising the market anything. So putting that aside, I think where we really focused on was the transformation of the business. We took two companies that had been founder managed. One was approximately 40 years old. The other one was approximately 20 years old. I'm talking about the company themselves, not the owners. And they were well-established Singapore-based businesses that both had overseas offices. And as we merged the two companies together, we created a company that has offices from Aberdeen to the Middle East, to the Caspian, through Southeast Asia, Indonesia, Singapore, Malaysia, Vietnam, and up through China and Korea. And so it became quite a big footprint for this group. And so what we've done is we brought in professional management. The owners have since moved on and retired, or the founders, I should say, have moved on and retired. They still have an ownership stake in the business. We've brought in professional management. We've launched a rebranding program for the combined entity so that everybody is operating under the same banner and flag. We've introduced ERP. We spent a significant amount of money bringing in the sort of technology that can help drive a business. Now, in the case of Amos sources, sells, and distributes thousands of products through its network of offices, of 12 offices around the world. At the end of the day, we're principally a logistics management business. And so the data is important for us to know what customers want, know where the product is, know what the delivery looks like. We've also spent time on redeveloping the facilities. So in this case, we owned several properties all around the world, including 5 in Singapore. 4 of which were really unnecessary and superfluous. So we divested those. Meanwhile, we built up our operations in places like Malaysia, in Singapore, and our existing site that we continue to own. And so we did a restructuring of just facility usage. We just didn't need as much space as we had. And so we did something else with it. And finally, we've introduced a new product line. We brought and introduced to the company our own in-house brand of Alcona. And Alcona is really for working men and women, whether it be uniforms, hard hats, safety shoes. But we also had a special focus on PPE last year. And so, you know, a year ago, PPE was not such a common concept. Fortunately, we developed a product line within the Alcona group that's targeting PPE, and all of a sudden it became very, very important. So within Amos and Gaylin, I'd say our efforts have been largely operationally focused, management team focused, working with the management team. And the financial side has sort of taken care of itself. We have less debt. We have a lot of cash now. And so, but it was at that point, I think our focus shifted from being deal doers to being business operators.
Mm-hmm. Okay. So let's kind of shift gears a bit to look at sort of the crisis. I mean, some of you have already alluded to it earlier, but the fact that, you know, this is all unprecedented and quite unlike the credit crunch of the past decade. But so just to understand though, you know, how did or how can sort of the earlier crisis inform your investment process now, in a sense? Maybe Katrina or...
Yeah, I think it's really hard to extrapolate, I think, from the previous crises, because obviously what we're experiencing now is kind of unprecedented from a health standpoint, right? So what we're finding is that we're just seeing a huge range of kind of attitudes amongst investors from kind of one extreme to the other, right? There are some investors who are just sort of petrified that we're like things are falling off a cliff and just want to hold on to a ton of liquidity and pretty much don't want to touch anything in the capital markets space. And on the other hand, we have investors who just see it as a huge amount of opportunity and are very active in investing. And you especially see that with a lot of the activity that's occurring so far in not just the Western capital markets, but with A shares as well. So it's, I mean, we're kind of seeing the huge range. So for us, the challenge is really how do we provide kind of a lot of different things on the shelf, right, to satisfy this wide range of expectations about the future, wide range of risk appetites, and also kind of, you know, liquidity sort of needs.
Mm-hmm. What about Harold? I mean, in terms of deal flow, for example, I mean, how does it compare to previous years, previous decades crisis?
Yeah, no. So I think that we're still seeing a lot of opportunity. I think opportunities will continue to come in. And as I've said, some of that real economy impact probably hasn't happened to its fullest, right? And so you're going to see a lot more probably in the next 3, 6, 9, 12 months time. So we think there's going to be plenty of opportunity. We've already seen a lot during this period. I think we're being a bit careful. Obviously because of the fact that real economy hasn't hit. And as I've mentioned earlier, there's also this dichotomy between certain businesses that are doing better in this environment and certain ones that are not. And that's probably something we didn't see in the last crisis because technology as a whole was not quite as big of a segment within the economy. And now it is a very, very big part of the economy. And so you're seeing kind of things be very different in the traditional business sense versus something which is a little bit more online. So we have continued to see funding rounds getting done. We have continued to see demand for tech businesses in particular who actually need capital for growth, not for liquidity issues or rescue financing. Of course, there are also those in the tech side that do need that. Not all businesses have done better during this crisis. But you know, we tend to work in a very alternative kind of space, right? So even for our private equity side, we run Indies Pelago Investments, which is our secondary share platform for tech, where we invest in more mature stage technology companies, but help with liquidity issues by buying shares from old shareholders. So in this environment, I think we're seeing a lot more demand actually. So we have continued to see that throughout this pandemic. In fact, as I've said, we've been very busy. So we've actually closed on I think, 4 transactions since this pandemic happened. So as a whole, we continue to see opportunities.
Mm. How about you, Carl? I mean, how has this informed your investment process, or how is your investment process now, as it were? I think, how do you do due diligence? How do you sort of manage even the existing portfolio companies?
No, I think, in large part, it's the same. If I think back to the global financial crisis, in the fall of 2008 till late spring 2009, there were opportunities because of liquidity crunches to do deals. And at that point, you just had to be very quick. And it was an extremely stressful period because the banks were all struggling. And I just recall even HSBC was rumored to have a failed rights issue, which ultimately got off. But that period was very stressful, and some people were quite desperate, and you had to be quick. This time has been different because the stress came in mid-March in the financial system, but it was over in 2 weeks. and since then we've recovered. And so there was really none of that stress that caused you to have to be making quick decisions. So we're actually still in a position where we can look at things, talk about them, think about how we want to do it, and what due diligence we need to do. The challenge, of course, is due diligence because of the restrictions on travel. So I think in this environment that makes collaboration with other GPs quite a good thing, quite logical, especially if that GP is in another location and you're both covering the territory in which the company operates. It also means that you need to work with consultants, advisors, lawyers, and accountants to do some of the groundwork that you might do. But probably the biggest impediment is that it slows us down in the initial review of a deal, because in the past, before COVID, we would get on a plane, go somewhere, visit people, take a look around, kick the tires, and that would help you to form your impression of whether or not you really want to do serious due diligence. Right now, we're a bit precluded from doing that, so we're sort of stuck just looking and thinking about it. Or if we do have somebody who's on the ground who can go visit, then that's a second alternative. So I think in a way, once we get serious about something, I don't think there's really much of a change in how we operate. It's probably in the initial phase where you think, do I really want to spend time and effort on this?
I mean, but how do you sort of price assets or evaluate assets at this time? I mean, for example, if buyers have become more cautious, but I don't assume that sellers have sort of adjusted their expectations accordingly. How do you?
Well, I agree. I mean, you're exactly correct. I think that we still, like most of the industry, have the same expectations on returns. We need to ultimately get sort of 20 to 25% gross returns on our investments over a number of years. We're not looking for a 6-month or a 12-month return. We're typically thinking in a 3 to 5 year range. The challenge, of course, is predicting the future and trying to forecast how the company will perform. That is extremely problematic. Again, because of the nature of the pandemic, we tend to operate with companies that are have several locations and have customers in many locations. So now you're really layering on a level of complexity. How is that customer? How are the customers of that portfolio company going to react? How's the supply base going to react? Ultimately, we're all concerned about consumer demand, right? What happens when you have such high unemployment and eventually some of the safety net from the governments is taken away in terms of payments to these people? How will they react? So I think it's a very uncertain future. And the one difference between now and 2008, 2009, and I was thinking about it, it's a little bit like 2003. In 2003, when we had SARS, that was obviously a health issue, but it very quickly turned into, at least here in Hong Kong, a political issue, because we had 500,000 people in the street on July 1st of 2003, marching for their rights. If you think about it, I mean, today, the complexity of Asian politics and the geopolitical position, especially with the biggest player out here, which is China, that also has created a level of uncertainty that's really none of us have seen in the last 30, 40 years, and how to judge the impact of hostilities between countries. And what does that mean to demand? What does it mean to competition? How are we going to react in this environment?
Yeah.
So I'd say this is a really difficult time to forecast the future. And I think for any investor who has capital, you need to be prudent. You're probably better off being prudent than brave in throwing money at something and sort of hoping for the best, because there's certainly enough warning flags out there to suggest caution.
Right. How about you, Harold? I mean, does this sort of mismatch apply in your case? So
Yeah, I completely agree with what Kyle said. I think if you look at the past issues, it happened pretty quick, especially in Southeast Asia, I think. Yes, there was this crunch in the GFC, but it was a short-term liquidity crunch, other than perhaps a few sectors in particular. Things then recovered very quickly. Domestic demand was still going up. This time it could be a lot more elongated. For the reasons we've already mentioned, the real economy impacts, government support slowly drying up. And so those things could really impact businesses over the longer term. Unemployment could be an issue, disposable income could be an issue. So, a lot of it is about the experience set of the investors within the firm, having seen through these cycles. And being able to at least differentiate between what happened in the past and what happened this time. So we've been fortunate. Our team, as I said, is kind of split. We have people on the ground, even in Indonesia. So, half of us are here in Singapore, half of us are there in Jakarta. We can obviously work online, but we also have the ability to continue with due diligence, meet stakeholders on the ground, and conduct due diligence during this period in a very, very effective manner.
what about the sort of expectations of both sides, the sellers or buyers? I mean,
yeah. I think the expectation set hasn't quite moved unless people are really in that liquidity crunch situation, right? The good thing about perhaps what we do is, unlike traditional purely equity, we don't always have to price the equity, right? You have other forms of collateral, and ultimately you can be more credit if it needs to be more credit-like as an instrument. And therefore people are not taking a hit on their equity valuation. I think that's what Kyle is talking about, where there's still a huge mismatch and people don't want to take a hit during this downturn. So in a sense, we can be an equity replacement tool for some entrepreneurs that need, and some businesses that need money. We're obviously not as long-term, perhaps slightly shorter term, and perhaps a little bit more flexible in the way we can structure things because we have both a credit and an equity mindset.
What about on your end, Katrina? I mean, what are you sort of hearing from the investors at least? What are you seeing in the market?
Yeah, I mean, I think there's just obviously a huge amount of uncertainty, and people are kind of. I would say, with everything that's happening from a geopolitical standpoint, it's probably thinking about that and the ramifications of that on sort of the economy and the different sort of sectors, and also different opportunities from a geographic standpoint, right? And you've seen something like for example with the ByteDance, right? There was a huge frenzy probably a month ago to buy those shares at a very high price, and then kind of with everything that's happened with India and with the U.S. and you see a lot of those like the geopolitical tensions impacting a private company. So people are probably a lot more cognizant of that. With regards to our Chinese investors, there's probably a sentiment right now to probably be more increasingly focused on Asian opportunities because of kind of the uncertainty and the impact of the pandemic on the US and Europe, for example.
I mean, just to follow on what you just said, Katrina, and this is a question for all three of you. Like you say, there's a lot of focus on Asia, and we've seen like the global GPs raise sort of huge Asia-focused vehicles. I mean, from your point of view, how has that changed deal making for you in this part of the world, especially in these times? Katrina, you want to take it first?
Yeah, so I would say for us, it's really been about basically shifting the focus kind of the opportunities that we have on our platform. I would say the split about 6 months ago was probably more 50-50 between sort of closed-end versus open-ended opportunities. And we had kind of a lot more, say, like VC or earlier stage opportunities as well, and less of the kind of the kind of income-oriented, like mid to single-digit opportunities. And it's been more of a pendulum swing towards that these days, where we probably have more, almost like 80% kind of more shorter term, kind of more open-ended strategies, or more credit-focused, more conservative, preservation oriented, and 20% towards the closed-end opportunities we have. The other 20% probably more focused on things like technology and healthcare.
What about secondaries on your end, Katrina? I mean, has the market, in your view, sort of adjusted to the pandemic? Are you seeing a lot more opportunities?
There are certainly opportunities, but probably not as much as we would have thought. There's, people are not. I think echoing what Kyle and Harold said, I think from a sell side standpoint, unless people are really distressed, we probably saw a lot more opportunities back in March when people had, family offices had to meet margin calls. And so there was a need to probably get out of things that they could get out of. But right now, we're not really seeing a lot of pressure from a sell side standpoint.
Right. What about for you, Kyle, in terms of competing with the massive global GPs and the huge Asia-focused funds? I mean, how does that change deal making for you?
Not really. I mean, they've always been there. They've always had deep pockets. It sounds trite, but a few billion here or there extra, it's not going to make any difference. So I think they're there, and they have their strengths, and they have things that they're good at, and they focus on them. But that's a narrow part of the market. And so there's still quite a wide piece of the market that's available for everybody else. And typically we're looking for deals 50 to 100 million US for us to write a check against. And, it's unlikely that those very large mega funds are going to be wanting to compete with us down there. Wouldn't be really economical for them. But we do think that the largest share of deal flow is in the small to medium size businesses out here in Asia, especially when you're talking about succession, when you're talking about consolidation, and even when you're talking about new technologies. I mean, the new technology type of deals. I'm talking about things that are still in a relatively young stage of their life are going to be lower priced, lower valued.
Okay. So just moving on a little bit, I'm just wondering, do you think that under today's circumstances, for example, I mean, just wondering, how do you protect your interest based on the kinds of deals that you're making, in structured credit, because for example, in traditional loans, I mean, you have all these covenants. From your end, how do you protect your interest and that of the LPs, actually? Harold?
Yeah. So look, in our more traditional business where we do mezzanine and structured equity, I think we generally take collateral, right? And that collateral can be in the form of a property or real assets. It can also be in the form of shares. Okay? A lot of which, for example, is in offshore structuring, right? And you can protect yourself a layer further by, putting in a repo type structure where you actually own the shares, for example, and then have an option for them to kind of buy it back. That's just an example of how you kind of protect yourself more during this period. But in general, most of our deals, particularly on the traditional side, I would say, does need to come with collateral. And as I said earlier, it also negates the need to price the equity, particularly when you're in a state of a downturn or a pandemic. And that generally helps getting deals across the line because entrepreneurs are most sensitive about their equity valuation more than anything else. We're also doing a lot of work, I think, in kind of a venture debt type structure. As I've said, we look at tech businesses as well. It's not true venture debt because we generally cover companies that are slightly larger, more mature. So we like to call it more mezzanine or structured credit or structured equity for tech businesses that are mature. And in that sense, you become super senior within the company because a lot of tech businesses obviously don't have existing indebtedness. And therefore, you're first kind of within that capital structure in terms of seniority. Of course, you don't enjoy the same returns as the typical equity guys who come in and share in all the upside. You have to structure the deals a little bit. But there's pros and cons of it. Obviously, you give the owners and existing shareholders less dilution in that type of structure, right? But you also have to give away some security. So, we always protect ourselves, I think, with a collateral package. As I said, it goes down to the experience set of the investors in the group. This platform has been around a long time, and our partners have been in Asia a long time, and particularly Indonesia for a very, very long time, and with good networks.
Right.
So a lot of the deals, I think, are won because we have on-the-ground teams.
Right.
So going back to your last question, are we really worried about all these global players? I don't think so. I think we sit in a niche where, we're a little bit more insulated from that. I think they will always be around, as Kyle said, and they will always have a lot of dry powder to spend.
Right, right. I mean, looking from the other side, though, what should businesses taking up, these alternative financing options that you're offering? I mean, what should they be ready for, in a sense? Kyle, maybe you can take this.
They should be ready for a new world. Things will change dramatically for them. So, I mean, a capital infusion will change things. Typically, you're bringing in new people as well because the company wants to grow and use the capital in some way, new businesses, new facilities, new product lines perhaps, but also corporate governance. So, a good lawyer can help you with the sort of protections you need as a lender or as a minority shareholder. As a majority shareholder, you need good corporate governance. But I think the phrase, trust but verify is very important. So for us as a GP, we need to be involved in the business enough to make sure that we understand what's going on. Because as recent headlines have shown over the last several months, corporate fraud is not uncommon. And so the company is going to have to get used to a more invasive or a more comprehensive set of corporate governance rules and requirements going forward in order to make the GP comfortable that GP is fulfilling his or her fiduciary responsibility with the company.
Right. Okay, Katrina, a question for you. I mean, just coming back to what you said earlier about how the secondaries market expected discounts have not quite materialized. I mean, I'm just wondering from your point of view, is it because, the PE portfolios have not been fully sort of marked to market? And then, if the sort of effects of COVID-19 have yet to be, fully accounted for, fully underwritten?
I mean, from what we're seeing, I think the secondary market is obviously it's a marketplace, so it's driven by the supply and demand, and just on the buy side, it's we see people gravitating towards certain names that people see as benefiting from this pandemic, and on the sell side, it really depends on kind of how distressed the sellers are and if they need capital, right? And from what we're seeing, most sellers don't need to sell right now. They'll sell for the right price. So it comes down to pricing, and it also, other factors as well in terms of like how tight the cap tables are, things like that. But to be honest, we're not really seeing a big drops as we thought we would see probably a few months ago heading into this.
Okay. This is a question for all three of our panelists. I mean, we've talked a lot about the amount of capital that's there in the market, a lot of dry powder. I'm just wondering how that's impacting, kind of the way, how do you stay competitive? Large amounts of capital chasing after a limited number of high quality assets and presumably driving up sort of multiples. So how do you sustain your competitive advantage in that sense?
Oh, maybe I can go first on that one, because I think, and we partly addressed it in the prior question, which is that we don't really see that as a major issue.
Okay.
Fundamentally, our business lines is kind of traditional alternative capital in the form of private credit, mezzanine, and or structured type transactions, and a lot of that is in Indonesia.
Mhm.
Where, as I said, it's about the network, it's about on the ground presence. We have a full team down there. And in fact, a lot of the global players, I dare say, will struggle to do due diligence in an environment where it's very, very difficult to travel, right? It's very difficult for them to then do the necessary diligence and take this up to a global committee that has to opine on something happening in Indonesia. And the pandemic is affecting countries all very, very differently, whereas we have a very localized view.
Mhm.
On the mezzanine or structured equity for tech, I think that's a sector where actually there are no other players at the moment that we're aware of that does this in scale. There's earlier stage venture debt, and there's a couple of good players there in Southeast Asia, but I think when you get later stage, there's probably less available, and certainly not a lot of the foreign players.
Mhm.
And our last strategy is in secondary shares for more mature stage tech companies. Again, that's not really a niche that all these big global funds look at. So for us, I think, we have a great on the ground presence. And so that's our competitive advantage in a sense.
Yeah.
And because our products are very much alternative to your traditional kind of private equity, we don't see that as that big of an impact where, they have so much dry powder. Should we really be worried about competition? I don't think we've seen that yet.
Okay. What about you, Kyle? I mean, also in terms of exits, is it going to be more challenging exiting at sort of, what is acceptable, vis-a-vis the public markets?
No, I think exits are actually going to be kind of interesting in the second half. I think that if you have a business that was prepared or came through COVID, if it came through it well, and you have the right sort of profile for that business in the future, I think there's going to be a lot of demand. And not just financial buyers, but also corporate buyers who are looking to deploy some of their cash. So from an exit point of view, I'm pretty optimistic if you have the right sort of business. And I don't think that's a small universe of what I call the right type of business. I think there's going to be many, many companies in that space. There's going to be a fair number of companies that are really bad shape and no one's going to want to own. And then there's going to be, the vast majority of companies that are in the middle. They're sort of doing okay, not great. Maybe nobody really wants to buy them, or the valuation won't be very robust. But I mean, we are in a hugely speculative market right now. I mean, if you ask me what I wish I did 6 months ago, I mean, somehow Zoom comes to mind, buying that stock. Tesla would be another one that I think I wish I'd bought. But, who would have thought Tesla goes up 4 times? But the kind of people who are making those kinds of bets and making that so-called investment are day traders and people very short-term oriented. And, that's not our game. We're investing for multiple of years. We can't buy it today and sell it next week because we've read the tea leaves and figure, maybe the bubble's about ready to pop. So leave those people aside. I mean, the speculative forces will play out until the regulators stop them at some point. But until then, you just play your game.
Right. So when's a good time to jump in? Nobody knows. We have last few minutes for some questions from the audience. I think the first one really, maybe you can take this, Katrina, from Casey Lim. Do you have a view on the fintech lending space, given the COVID-19 led contractions, with banks being more stringent on loans? Are there growth opportunities for fintech lenders in Asia, Southeast Asia?
That's probably more of a question for Harold, I would think. I don't really have a view on fintech lending.
Oh, sorry, fintech. Harold, maybe, yeah.
Sure. Look, we would look at fintech companies as well, in this kind of cycle. But, I think we'd be very careful as to which area of fintech lending. Obviously, as we've discussed, there's going to be a real economy hit here on the consumer side. And I think that is still making its way through the system. And P2p lending, in the more traditional sense, where you're going towards SMEs or invoice financing, is also an area we're looking at. And I think it's going to get more institutionalized over time. So it's not a true P2p lending scheme. I don't think there are enough depositors or investors on one side of that pier. And so in Southeast Asia, I think it's going to quickly become more institutionalized. And so those are types of deals I think we would be open to looking at in the right parameters. But I think it's also a time to be careful actually right now.
Right. Also for you, I think, does venture debt fit the bill for larger LPs who are interested in Asia as a market?
Yeah, no, I think it does. I think it is a very interesting sector. If you look at the US, for example, I think 10% of every equity dollar into venture companies ultimately also gets invested as, for example, venture debt, somewhere between 10 to 15%. I think that's still very, very young within Southeast Asia. It's still pretty small. As I said, there are a number of people who do that pretty well, particularly for earlier stage companies in Series A and Series B. Our focus is perhaps slightly larger size, larger ticket size, and differentiate ourselves a little bit by providing kind of a bullet type structure so that these companies really have that runway to their next fundraising round. And when you're backing these tech companies in the earlier stage of their life cycle, you're really betting on that next round to be able to repay your financing.
Yeah.
Right. So I think it's something that's very, very interesting. I think LP should start looking at it.
Right.
And I think it will continue to grow as tech continues to become a bigger part of the economy in Southeast Asia, just like it has done in the US and China and elsewhere.
Okay. Let's think about ticket sizes though. I mean, how have the average ticket sizes been affected due to the pandemic? I mean, is this a time for bargains to acquire majority stakes? Or, are you going to be more cautious with the smaller ticket sizes? Kyle, maybe?
No, I think this is, I think if you find a deal that makes sense, I don't have any issue about writing a bigger ticket size. I don't think they've come down in value. As I said, we typically are looking for anywhere from 50 to 100 million. We can go bigger than that. But I think if the right sort of deal came along, we would have an appetite for it. I don't think you reduce your risk by writing a smaller check. In fact, I think in today's environment, bigger deals are probably more attractive than doing very small deals. There's more heft to the business. There's more substance to it. There's more room to grow the business. And a lot of what we do as a GP on the operational side is applicable whether it's a 10 million revenue business or it's a 300 million revenue business. And clearly we get more bang for our buck in our efforts if we work with the bigger companies.
Okay. Last question, I think, from Shweta, who's the CEO of Start Right Business Solutions. The question is for Harold. I think Indies Capital usually invests in startups at mature or pre-IPO stage. Is the Special Opportunities Fund considering growth stage companies in tech as well, such as in health tech, or especially in health tech?
Yes, we do. So it's a little differentiated, I would say, between our private equity kind of secondaries platform. So that one generally takes direct equity stakes, right? And we're buying secondary shares of more mature stage tech companies from early shareholders. On our credit platform, and we've just raised, as you mentioned earlier, first closing of Indie Special Opportunities 3. That fund, for example, would do credit or structured equity type transactions for the same cohort of tech companies that we would look at, which is the more mature stage players, right? And we can offer, as I have mentioned, kind of a mezzanine or structured equity type structure. So it's not true venture debt. It's structured perhaps in a more traditional sense as compared to venture debt. But yeah, we can do that from our credit fund as well.
Okay. Katrina, do you have any comments to add to the last few questions about ticket sizes or about even, in earlier stage tech companies?
Right, can you repeat that?
Sorry, you're on mute again. So just wondering whether you have any comments to add on the earlier questions. Two things about ticket sizes, whether, there'll be, how have they been impacted by the pandemic, and as well as, whether opportunities in earlier stage tech companies, specifically, for example, in health tech, some of the hotter sectors, as it were.
Yeah, we haven't really seen much impact on ticket size. I would say it's really more about, shifting focus to types of opportunities. So there is a lot of interest in obviously technology, healthcare, life sciences, et cetera, even education, right, with regards to sort of more digital education, because just capitalizing on a lot of the trends that are benefiting from the pandemic. I would say, as far as we are seeing in terms of the fundraising, it's really more about things are just taking longer. So a lot of the GPs that we speak to, depending on where they are in the fundraising cycle, are just generally prepared for kind of a longer fundraising process.
Great. Thank you to our panelists, Harold, Katrina, and Kyle, for taking this hour. And thank you also to our attendees for staying with us and submitting your questions. This has been a webinar on alternative financing. It's 3 o'clock, we have to go, but do stay tuned for your transcript as well as the audio that will be sent out to subscribers, and as well as for our future webinars. We're planning to have at least one a month, so look out for the next one. Thank you everybody, and
thank you, everyone.
Good
Thank you. Bye.
Bye.